The Capital Business Analysis of the St. John's Club. In this paper, we are going to look at the analysis of a local private club and determine whether we would want to offer them a loan as an investor. We will do this by looking at everything we've learned in the class Finance for Leaders, including equations and other analysis techniques. The St. John's Club. This is a small, private, not-for-profit club in Burlington, Vermont on the shores of Lake Champlain. There are approximately 2,000 members at this time, all of which pay dues to become members. The club is run by a manager and overseen by a board of trustees. Their mission statement is in regards to community building and fundraising. We're going to look at two different sheets provided by the club that we use to analyze their current financial status. The first of these is the balance sheet. So we can see that the balance sheet is from 2015. Their 2016 financials are not yet available. So we'll be using this as the quote-unquote current year. We can see per the balance sheet, most of their actual funds available are in the checking account and savings account. There's a small amount in the savings account, so there's a very small portion of their funds actually gaining any interest. We can see that the club has a bank loan out of approximately $85,000. This was taken out a few years ago when there was actually a natural disaster, Hurricane Irene, and what happened was the bank of the club going down into the lake actually eroded, much of it going into the lake. In order to stop that from happening, the club had to take out this sizable loan in order to build a seawall. This fixed the problem and hopefully is going to make sure this doesn't happen again. The balance sheet in the financial world represents a picture taken at a specific point in time, a date, that shows a firm's assets and how those assets are financed in regards to debt or equity per our textbook. The balance sheet gets its name from the fact that the two sides of the equation above, or in this case, over, assets on the one side and liabilities plus shareholders' equity on the other must balance out. This is intuitive. A company has to pay for all the things it owns, which are assets, by either borrowing money, taking on liabilities, or taking it from investors, issuing shareholders' equity. This is from an article in Investopedia. In another article, from Accounting Coach, it states, since a nonprofit organization does not have owners, the third section of the statement of financial position is known as net assets instead of owner's equity or stockholders' equity. If a donor does not specify a restriction on his or her contribution, the amount received by the nonprofit is recorded as an asset and as unrestricted contribution revenues. Unrestricted contribution revenues reported on the statement of activities also cause the amount of unrestricted net assets to increase. So you will see that they do have unrestricted net assets listed on their balance sheet due to their not-for-profit status. We can also see that it does list out the fixed assets and all of their current liabilities, whether they be long-term or short-term. Long-term liabilities are typically paid off in over 1 year, whereas short-term liabilities are paid off in less than 1 year. We also see that we have the profit and loss statement from the St. John's Club, and this is a statement from January through December of 2015. This statement shows their income and the different types, such as beer sales, liquor sales, food sales, room rentals, membership costs, and whatnot. We also see a list of the cost of goods. So this is the list of purchases that the club had to make to keep running, such as the alcohol, the food, contracted labor, restaurant supplies, etc. We see the listed gross profit. We also see a list of their expenses, such as DJ services, internet expenses, paper goods, property taxes, payroll, salaries, and the like. We do also see of note a potential red flag of underneath expenses listed as penalties. In interviewing the manager of the St. John's Club, it appears that their taxes are not always paid on time, and these are penalty fees that have been added in. Finances. And I quote from our textbook, in simple terms, finance is concerned with decisions about money, or more appropriately, cash flows. Finance decisions deal with how money is raised and used by businesses, governments, and individuals. To make sound financial decisions, you must understand three general yet reasonable concepts. Everything else being equal, 1. More value is preferred to less. 2. The sooner cash is received, the more valuable it is. And 3. Less risky assets are more valuable than preferred to riskier assets. We're going to see for the St. John's Club that they have a decent amount of value, that the cash that they receive is soon, and also that their assets are pretty low in risk, as we will see that they don't have stocks, bonds, and whatnot. They did take out that pretty sizable loan that we mentioned earlier, but they are paying, per the manager, $3,000 per month on the loan, which per the loan standard for this bank, they only were needing to pay a little less than $1,500 per month. So they've actually doubled the payment on it. Depreciation. We also want to look at this when we're evaluating any business. Per the IRS, depreciation is as follows. Depreciation is an income tax deduction that allows a taxpayer to recover the costs or other basis of certain property. It is an annual allowance for the wear and tear, deterioration, or obsolescence of the property. Most types of tangible property, except land, such as buildings, machinery, vehicles, furniture, and equipment, are depreciable. Likewise, certain intangible property, such as patents, copyrights, and computer software, is depreciable. In our textbook, it states and explains higher depreciation expenses result in lower taxes, hence higher cash flows. So the amount that we actually see on the financial statements from the club, they have a pretty good number, or amount, I should say, of depreciation expenses, which actually helps to lower their taxes. The textbook continues to explain that there's a major classes and asset lives for MACRS, MACRS, in which companies can actually analyze and evaluate their depreciation costs. So for the club, they have a bunch of kitchen equipment, computers, office supplies, and whatnot that we can actually count the depreciation costs for, enabling them to lower their taxes. The pro forma analysis. So what this does is actually looks at possibilities for, the next fiscal year, the one after that. In our study, we estimated a 10% increase in the cost of goods for each of the next 2 years, as well as a 10% increase in sales in each of the next 2 years. We used Excel to perform this task, so you can see that we've broken down the financial records from the club and estimated these 10% increases in costs and also in sales. In our textbook, it quotes, any forecast of financial requirements involves determining how much money the firm will, 1, need during a given period, 2, generate internally during the same period, and 3, have to raise externally by borrowing, issuing new stock, or both. One method used to estimate the funds that need to be raised externally is to construct a projected or pro forma balance sheet. The projected balance sheet method begins with a forecast of sales. Next, the income statement for the coming year is projected to obtain an initial estimate of the amount of retained earnings that the company will generate during the year. This step requires assumptions about the operating cost ratio, tax rate, interest charges, and dividend payments. In the simplest case, it is assumed that all variable costs will increase at the same rate as sales. So what we're not sure, looking with a 10% increase in sales, we're not sure, will there need to be an increase in payroll, an increase in utility expenses? Will the meals and room tax go up? Licensing permits and whatnot. And that's not so much because of the increase of sales, but licensing permits, meals and rooms tax and whatnot could just be that the government in the following years could actually change their percentages that need to be paid. Payroll, utilities, etc. could potentially increase with an increase in business. Operating leverage. The club degree of operating leverage is low, due to the size of the business. The operating leverage is the amount of money that a company has to pay at a basic rate, day-to-day basis to keep their doors open and to run the business. As you see an increase in sales, typically the degree of operating leverage will increase. However, with a company that has a pretty good set standard of degree of operating leverage, it will not increase as much with a small increase in sales. Per our textbook, the value of the degree of operating leverage indicates the change in operating income that results from a change in the level of operations, regardless of whether the change is an increase or it is a decrease. So, things that the club has to pay for on a day to day basis: payroll, licensing and permits due to its bar and restaurant status, utilities, and whatnot. With an increase in business, we could certainly see this increase as well, but it would certainly be dependent upon how much the business increased. Liquidity. This is one of the first evaluations or analyses that we're going to do to check on the St. John's Club. Per our textbook, a liquid asset is one that can be easily converted to cash without a significant loss of its original value. Converting assets, especially current assets such as inventory and receivables, to cash is the primary means by which a firm obtains the funds needed to pay its current bills. Therefore, a firm's liquid position deals with the question of how well the company is able to meet its current obligations. So certainly a place like the St. John's Club has inventory of food, alcohol, and beer, wine, liquor, whatnot. And what they hope to do is to sell those items, and then they are having a cash flow into the business. The two equations we looked at were the current ratio, which is the current assets divided by current liabilities, and also the quick acid test ratio, which is current assets minus the inventory divided by the current liabilities. So we do see that these numbers are pretty high, 34.03 times and 33.37 times. Industry averages that I could find based in the restaurant field, as I could not find industry averages for a bar or a private club, this was the closest we could find, were listed as 0.73 and 0.18 respectively. However, I did note on the club financial sheets, the inventory stated listed only the food inventory. There is certainly a large inventory of restaurant supplies, beer, wine, liquor, and the such. So I'm thinking that these numbers are probably skewed. Financial leverage is the next analysis we look at. This is the use of debt financing. Financial leverage or borrowing affects the expected rate of return realized by stockholders for two reasons. First, the interest on the debt is tax deductible, whereas dividends are not. So paying interest lowers the firm's tax bills, everything else being equal. Now, even though we know the St. John's Club does not offer stocks, as we see on their financial records, they do still have liabilities. And per the textbook, the debt ratio measures the percentage of the firm's assets financed by creditors or borrowing. So, again, we bring up the bank loan. The St. John's Club needed a significant amount of money to fix a problem, and they did have to take out a liability in the form of a loan. The two different equations that we used: one, the debt ratio, total liabilities divided by total assets, or we're also able to take the current assets divided by the current equity. We get 0.78 and 0.38. The industry standard that I could find for the debt ratio is 1.24. So we actually see that the club is doing better than the industry standards in the restaurant business, as their debt ratio is 0.78. This number you do want to be lower than the industry standard. Asset management. The asset management ratios measures how effectively or efficiently the firm is managing its assets. The ratios are designed to answer the following question: does the total amount of each type of asset as reported on the balance sheet seem reasonable, too high, or too low in view of current projected sales levels? So there's two different equations that we use for asset management. The first one being fixed assets turnover ratio, which were sales divided by net fixed assets equaling 2.11. Total assets turnover ratio, which are sales divided by the total assets equaling 5.04. The industry standards for the turnover ratio, the fixed assets turnover ratio is 2.0. So we can see that the club is actually averaging better than the industry standards. The total assets turnover ratio being 5.04 shows that the club is in general making $5 on every dollar, which this seems to be a pretty good, reasonable number to me. Profitability. This is the net result of a number of policies and decisions. The ratios examined thus far provide some information about the way the firm is operating, but the profitability ratios show the combined effects of liquidity management, asset management, and debt management on operating results. So what we see, the net profit margin, which is the first equation that we're looking at, looks at the profit per dollar of the sales at the club. So the net profit margin is the net income divided by sales, and this equals 8% for the St. John's Club. So we're seeing that they're actually making about 8% on the dollar. There's another equation, return on total assets, which you can divide net income by total assets, and this equals 41%. In an article entitled The Average Profit Margin for a Restaurant, the author states that anywhere from 2% to 6% is good for restaurant standards these days. So as we can see, the net profit margin being 8% for the St. John's Club is pretty high, higher than the 2% to 6%, and again, shows some good financial soundness. Market value analysis. So we were unable to actually calculate this for the St. John's Club since they do not offer stocks and bonds. But let's look at what this is, as this is an important analysis tool for businesses of the such. The market value ratios relate the firm's stock price to its earnings and book value per share. They give management an indication of what investors think about the company's future prospects based on its past performance. If the firm's liquidity ratios, asset management ratios, debt management ratios, and profitability ratios are all good, then its market value ratios will be high, and its stock price will probably be as high as can be expected. Of course, the opposite is also true. That was per our textbook. So, the higher the stock price is, certainly the better and more interesting to the investors. One of the equations that can be done is the price per earnings ratio, which divides the market price per share by the earnings per share. The EPS, the earnings per share, can be calculated by dividing the net income available to stockholders, the dividends that could be paid out to them, by the number of common shares outstanding. The higher the number, the less risky the business is considered, and that's usually generally good for investors. We can also look at an equation, the market book ratio equation, which takes the market price per share divided by the book value per share. The book value per share can be calculated by dividing the common equity by the number of common shares outstanding. The hope is for a sale of a higher amount in stocks than the actual current book value. That's what a firm generally looks for. Return on equity, also another difficult thing to calculate for the club since they don't offer the stocks and whatnot. But the return on equity is explained as the return to the common stockholders. So certainly a company that can provide a higher return to their stockholders is going to be of more interest and more popular to investors. Investors want to make money on their funds. In our textbook, it states that this is a ratio calculated by dividing income available to stockholders by common equity, and it measures the rate of return on common stockholders' investments. The return on total assessments can be calculated by using the DuPont approach per our textbook, which is a formula that gives the rate of return on assets by multiplying the profit margin by the total assets turnover. The ROA then can be used to calculate the return on equity by multiplying the ROA by the equity multiplier, which is the ratio of assets divided by the common equity. This approach will enable the company and the investors to realize the success or perhaps not success of the stocks in the firm. Economic value added. This is explained as the economic value added measure is based on the concept that the earnings from actions taken by a company must be sufficient to compensate the suppliers of funds, both the bondholders and stockholders. So you certainly want to have economic value added. The more economic value, the better for the investors, and the more willing they would be able to invest more funds and for the company to gain new investors. If the economic value added shows an increase, then the value of the firm should have increased as well, which is very important to these investors. Capital structure. For any business to be successful, they must constantly be looking at capital budgeting and capital structure. In our textbook, it lists that the four main decisions that a company looks at in capital structure are business risk, the tax position, financial flexibility, and managerial attitude. The company has to look at the risk to the business, how it's going to affect their taxes. Are they able to be flexible in that in an adverse situation? Can they quickly generate funds to pay for that situation and the causes or issues coming from it? And managerial attitude, are they aggressive? Are they conservative? What we do need to remember is that in this study, the St. John's Club, it's a not-for-profit, and as I quote, to be officially recognized as a nonprofit organization requires incorporation's filings with with both the IRS and the organization's state of legal residence. Because it is assumed the purpose of the incorporation is to provide a community service rather than operate as a traditional business, special laws exist relating to tax-exempt status granted to the non-for-profits. So we can see that the St. John's Club certainly has some other tax breaks that regular companies don't have. So that is certainly something that the club can take into account when they are choosing on their capital structure and budgeting. So also we learned in our textbook, when working on a capital budget plan, the firm needs to look at the following: sunk costs, which are unfortunately funds that are spent at looking at new project ideas. Those cannot be gotten back, and so those are not necessarily factored into the capital budgeting analysis. Opportunity costs, what the profit that you can make on a new project versus if you put it towards something else. Externalities, with this new project, how will it affect the rest of the company and that processes. Shipping and installation costs and inflation, which we all know what those are. The capital structure of the company is how they determine how much debt and how much equity to use. In conclusion, show me the money. I would certainly say that the St. John's Club is a safe bet in the financial world with this snapshot of time from 2015 that we've looked at. They are making a good profit. They have funds available in case there was an issue or an emergency. They seem to have made good financial decisions. In the studies that we did, they seem to be above industry averages. They have good membership numbers. They currently only have the one loan out that they are, as it stated, paying twice the amount on. And just really overall good numbers. I certainly, as a member and recently elected board member of the Board of Trustees at the St. John's Club, I knew that business seemed good to me and that I see a lot of people in and out the doors. I never knew how to evaluate the actual business looking at the numbers. In my mind, just seeing a good amount of money in a checking account seemed good. That was at the beginning of this class. I certainly now understand and know how to evaluate the soundness of the financial status of a business, and this one does seem to be a good bet. Certainly there are the couple of red flags that we brought up, the penalty fees on paying the taxes, but we also don't see any penalty fees for paying the loan late, so that's good. Also, unsure of why the inventory listed on the financial statements did not include anything but the food prices. So, overall, good business, good safe bet in the financial world, and I hope that the club continues to do well in the future. Thank you so much, and I hope you enjoyed listening.